If you want to start or scale your property development business to 8 figures and beyond, then you're in the right place. This is the Property Experts podcast with Ben Richards and Jack Diggins, two serial entrepreneurs bringing weekly insights from our award-winning businesses. In these podcasts, you'll learn how we found, funded and delivered over £80 million worth of property in the last 6 years, with templates you can use, deal analysis and deep dive discussions that will help you build your businesses successfully. We hope you'll enjoy.
Hello everyone, happy Friday. Sun is still shining. If you haven't joined us before, it's always the way, I get a phone call as soon as we go live. If you haven't joined us before, this is the Property Experts podcast. We go live every Friday without fail and have done for years now. And we try and bring value to people in property, people in construction, entrepreneurs and business owners. And we've got quite a lot of macro stuff that we're going to be talking about today, including investor expectations on returns, including the government, including the sales market, which is all really important stuff. And as always, we do Q&A all the way through the session. So we are live. So if you've got questions, whatever platform you're on, please do ask questions because we will answer them live. And don't worry if you're not watching it live, because you can always ask questions and we'll come back to them the following week. For podcast listeners, it's the 24th of July, which is my daughter's birthday. And
happy birthday, Blue.
Yeah, happy birthday, Blue. We're going to be talking about PD scheme under offer in XP, and we need partners. We need partners for that project. So we're doing a little bit of a shout out there, talking about investor returns. Obviously, as you know, we'll share after this slide, our business is typically collaborating with private investors or even family offices to do projects that we do. We're kind of the action and the deliverables, and they're the backers. And we're going to be talking about conversations that we've had over the last few weeks about expectations. We've got a few open vacancies across the teams. So if you know anyone looking for work that will fall in the criteria, we'll be sharing what we're looking for. Andy Burnham this week, I think it was Monday, took his place at the 10 Downing Street. And yeah, we're going to be sharing the changes he's already implementing, and then maybe some more generic views about what we can expect as business owners and property people. And yeah, talking about each topic around there. We're going to be providing a sales update. We've got stock for sale in the market. Ben's going to be sharing some more AI skills. And then last but not least, we're actually going to generalize and talk about what the sales market needs. And I think that actually falls into government changes as well. So quite a lot of macro stuff, which is good. And as always, Q&A.
Sorry, my tech is on the go slow today, so bear with.
It's still warming up, Ben.
Yeah, I've literally just got in and turned it. I actually ran and chased the DPD delivery driver on Tuesday because I'm meant to be having a PC delivered, and I missed it by 5 minutes. And I ran after him in the road and said, "You've just missed me. Can I have it?" And he basically ignored me, said he's too busy, he's on a clock, and I can't get my PC. And it's now been sent back up to Warwickshire to then be delivered next week, which I'm really pissed off about because I was hoping this weekend I could get into the setting up and all that sort of stuff. But there we go. Tech is now working again. Off you pop.
Love it. So if you haven't followed our channel, Ben and I run multiple businesses that all fold into each other in our ecosystem, including surveying, architecture, development, letting, sales and management at the tail end. Well, more actually prevalent at the moment, sales. Our goal is to deliver 1,000 homes and £1 billion worth of property in the UK. And we do that with trusted investors. So there's going to be a bit on investment stuff today, which actually brings us quite nicely into a segue. We probably won't spend too much time on the next slide because we have two deals in legals, actually. One's a commercial scheme with new build scope, but we also have a new PD scheme under offer. We do have an existing database, an existing close network of investors that we would love to continue working with, but sometimes timing isn't right, the project might not be right, and we always want to ensure that when we're out there in the market space that we've got the right partners lined up for the right project. So if you are interested even in a small ticket to start or even earn and learn or even the bigger ticket stuff, we're confident as delivery people and we'd love to hear from you. separate to our asset-backed investments, XP Surveys is on a growth trajectory. We've been growing, I think, something like 20 to 30% year on year, which is pretty strong for a service-based business. And we want to grow even more. And to do that, we need to bolster some investment into that. Not only are we already invested into the business to get to where it is, but we've also got the capabilities to invest ourselves. But we're looking for someone to come on the journey and support that growth of our business that we want to take national. So if you're interested in that too, I feel like it's quite a heavy investment session, but we need it. Onto referrals. We have plugins, tools, subscriptions, services that we use, tried and tested. And quite frankly, a lot of these that we couldn't live without. And the only reason that we reach out to these businesses to get referral links is because we believe in the product. So if you need any form of recommendation for any tool, or you would like to utilize one of these, most of them are sort of free trial anyway, but it benefits us, benefits you. I think you get credit on your account, and so do we. But we've got a plethora of companies that we use, suppliers that we use, brokers that we use. Most of these are finance and accounting tools. But if you cannot see your financial data accurately week in, week out, it's very difficult to run a business. So you could just comment referral or check the referral links in our description and utilize these services. Cool. So really good news this week. I feel like after a little bit of a dry spell, we've got a deal under offer, and it's a very straightforward PD scheme. And the reason I wanted to share this today is not only because it's our typical bread and butter, this type of scheme. It actually looks very similar to a scheme that we're finishing at the moment. And I think is a good ticket size. You know, the typical investment for this type of project is about £1 million. And we do have people that we can go to for sure, but we're always trying to broaden that network of people so that the right person fits with the right scheme at the right time, which, believe it or not, isn't always easy, even once you've been running for almost 10 years. But we're always looking to foster up and strike new relationships. And actually, quite a lot of our investors bring not only the capital, but also the deals as well, and come to us to deliver them. So if you are a listener and you've been listening to us for a week, a year, 5 years, whatever it may be, please do reach out. It just starts with a no obligation conversation. We tell you about how we structure things. Ben and I have literally just got off one of those phone conversations with a couple of investors, and you just sort of ask each other questions, see how you could maybe find a workable collaboration, and then you get cracking. And we, basically deliver the scheme, and you can, be completely arm's length armchair investor, so you're not really too involved. There is obviously the opportunity to learn what we're doing and learn what we do on our projects, or you could actually get involved. So we're open, we're flexible, but we'd love to hear some feedback. Next, I think it's heavily weighted towards me at the beginning. So I actually put this in here because I bumped into an agent who's been working in commercial and residential sales for 40 years. And obviously, old age question at the moment is like, how are you finding the market? How are you finding business? And I don't think it's easy. And I've actually had 2 conversations with people that have been in these industries for 40 years. A couple of recessions, these 2 sort of grey-haired advisory men. And neither of them have said it's actually an easy market. A lot of them have said it's actually worse than some markets that they worked in before, at the worst point. And I kind of said it's really difficult for us because we need speed on sales and value on sales to get things sold. We'll come to the end of the session about incentives and how we could potentially be supported in the sales market. But I said it's kind of a very difficult market to be in, because even though it seems like there's low activity on exit, there isn't the price adjustment at the beginning. So it's kind of like you can't buy and you can't sell. So what do you do? Well, when I say can't, you can, and we'll share more about that later in this episode. But it's almost like you're not picking up the sort of 60p and a pound deals because there's distress in the market. It's all very slow and elongated and very painful. We have bucked that trend a little bit by getting a couple of deals under offer, but I kind of find it is difficult to get into those deals. And what I wanted to share is as we work with investors, we communicate with them. We say, what are you seeing? They might have a diverse portfolio across different asset classes, across different property strategies or different deliverables under property. And I'm kind of getting the impression that expectations of returns are coming down. So, even to the tune of a couple of percent, because it's just known that it's not easy to do what we're doing in this market. And it's probably not the case of doing a completely award-winning deals and, circa 20% return on cash and all of that sort of jazz, all money out deals. It's more actually consistency, measuring the risk, delivering, and managing the storm, because it's not, we've had to do quite a few things differently, including bringing sales in-house to combat that difficult market. Whereas if this was a pumped market, we probably wouldn't have to do that. Sales would be a bit more assisted and speedier. There might be government incentives like Help to Buy helping that sales market. And as a result, you churn and you buy more, etc. And you could probably be a bit more aggressive on the acquisition side. So maybe it's my attitude on the acquisition side, but I just wanted to share that the market is softening in every aspect, the investment side, the acquisition side, not as quickly, which is painful, but the sales side, it's all sort of softening. And it's kind of like there does need to become, I believe, a big breaking point for that to drastically change and for big measure to be made. We'll come on to Andy Burnham's sort of proposals and what he's proposing me doing. But I just think that we need a lot more of an aggressive tact. And as much as people hate Trump, he does get stuff done and does build drastic change when there are problems. And I feel like we just keep buttering up problems and not really moving the needle on those macro issues. Anything else to add, Ben? I actually can't. You're on mute.
Did you go into kind of some of the actual sort of percentage returns that people historically expected and what they should be expecting now?
Yeah, I suppose I could, to be fair. So we typically work in the space of second charge lending. We've actually found it very difficult to place capital on first charge lending, because if an investor wants 8 to 10% on a development loan or bridge loan, the problem you have with that particular investor is if you then bought a site for £1 million, for an example, and you geared a 70% LTV loan with them, yes, it's more easier to manage. It's cheaper to get the loan drawn down. There might not be any arrangement fees. But the problem comes around is when you then might need £2 million to build it out, you've got to get rid of that investor and get some other capital in that has that development facility, because typically individuals might not have the facilities like banks do. So typically first charge debt, we're blending out at about, I would say, 9 to 10% annualized. I know, Ben, I actually saw on our spreadsheet the other day, even though it was a slightly higher rate 2 to 3 years ago when we struck that product, it averaged out about 11.5%. So I think debt's between 9 and 11% blended for bridging development and the type of stuff we do on a first charge. We then have different stock like stabilized complete assets that are income producing. You could expect investors wanting anywhere between that sort of 8 to sort of 13, 14%. To make that deal viable for them. They may have different, I would say that a SaaS investor would typically expect lower returns because there's huge tax benefits for them and they can't deploy it into anything. They've got to be strategic with that SaaS. Whereas if it's private capital, they might want a higher ratio of that. Then typically mezzanine lenders. So these are commercial outfits that will lend the riskier slice on a second charge about 20%. I'm not a massive fan of paying any higher than that. So if you are then going down private lending, it's got to be between that sort of 14 and 20%. But I kind of feel that the private market has moved down a couple of percent. So 200 basis points essentially, which is because of the nature of what we're doing. It's almost like the less they warrant, the more viable the scheme is, the less risk everyone carries. Because the last thing you want to do is have a scheme where the cap stack falls out, where the investor's capping it out and they're not incentivized to deliver on it. And I mean, that's more maybe a bit more of a moral obligation. I kind of feel like we'll deliver it even if there's no margin per se, just to get the deal done. But that's roughly, does that make sense?
Yeah, it does. I think that's a really good point, the end one, in terms of I have actually spoken to a number of people in the last few months where they got into a deal 2 years ago, and I said, well, what you pay? Because they brought some equity in as debt. And I was like, well, what are you paying your debt? And they said 30%. I was like, you're mad. And they're probably, well, they are now really, really feeling the pinch of that, because they're at the end of a project. They can't sell anything because the market's really slow. They're at their peak loan from a first charge perspective, and they're also paying 30% to their equity, which isn't sustainable. And like Jack says, I think there has to be a realization of risk here, and what is actually acceptable and sustainable within a development project, and that level of interest rate just isn't sustainable. So I think the figures that you've mentioned are great for people to sort of understand. Largely it's going to depend on the project itself, the individual, their situation, our situation, the project. There's lots of variables that go into this, so it's never a fixed, this is what it needs to be or shouldn't be. But I think those figures are a good guide for people to sort of take away and think about what could be done on their own project. So yeah, no, it works well. Cool. Anything else you wanted to say on that?
No.
Cool. We have lots of available spaces within various businesses for various reasons, and I wanted to talk about some of the recruitment drives that we are currently operating across those businesses. So I'm going to start with Aura. We are picking up a lot of developer and investor type work, and I want to grow that portion of the business dramatically over the next couple of years. We're splitting out the developer side of the business from our main aurahomes.co.uk website. It's going to have its own domain. It's going to have its own it's already got its own Instagram handle. It's already got its own YouTube channel. We want to work more with investors and developers, just like XP. And that's where I feel like our skill set and my understanding, knowledge, and drive is best placed. We've grown a really, really, really good niche in the homeowner space. Like, we serve private clients really well, but I really want to then grow the developer side of the business, and we're splitting that out. So what we're looking for in that business is an architect, could be a technician, could be a technologist. I just want somebody that is operationally minded, that has a good technical understanding, is used to working on tight constrained sites, typically from one house up to 30 units, understands PD, has that developer mentality where commerciality is key, optimizing gross development value, reducing build costs, maximizing margins, squeezing every bit of value out of an asset as possible. If that sounds like you, if you're an architect that is fully qualified, REBA chartered architect, probably got at least 5 years experience working, as a qualified architect, has worked on small, SME type developments, from PD conversions to new build schemes of up to probably 30 units, then I want to talk to you. It's an exciting time for the business. We're restructuring. We're refreshing the brand. It's a really good point to get into the business and start to grow that development side of things. There's a lot of growth potential within this role. Ultimately, I want to be stepping away from that side of the business as much as I can to focus on our own developments. So there's an opportunity here to start in an operational role, but really kind of work into a more sort of senior leadership type role, and grow that side of the business, build relationships with other developers, and really get stuck into the growth of that development, that department within the business. So if that's you, if you know of anyone that is based in London and wants to work on those types of projects that I've just mentioned, if they can send their CV and portfolio to info@aurahomes.co.uk, I would be I would love to review those CVs and maybe get you on an interview to have a chat. Number two, like Jack says, we've taken the sales process within most of our sites at the moment in-house. We have had lots of success with our meta campaigns, and we continue to do that. What we need is somebody full-time to come in as a sales negotiator to help take all of those leads, feed them through our sales funnel, update databases, help out with ad campaigns, marketing, negotiate offers to completion. And we've got a really, I think, solid kind of package and commission structure available for the right person. We're not necessarily looking for someone that's super senior at this point. The strategic direction is sort of led by Jack and I. We do want somebody that's hungry to learn, hungry to work for a small developer with lots of opportunities and some exciting projects coming through the pipeline, as well as being finished off currently. And again, if that's you, or someone that would be interested in that, probably from some sort of estate agency background or new home sales background, then drop the CV to info@xpproperty.co.uk. Cool. On to XP surveys. We're going through all the businesses today. CAD technicians and junior surveyors, we want to hear from you. If you've got good CAD skills, if you are an architect and you want to venture into more of the engineering and technical side of geospatial surveying, then this job is for you as well. We want somebody that has a good understanding of using AutoCAD. Revit skills would be a bonus, but not a necessity. There'll be full training for using all of the high-tech laser scanning equipment, how to post-process point cloud data, and we want someone hungry to learn and get stuck in to that business. Has to be willing to drive and actually go on site and do surveys, as well as having that CAD understanding back in the office. And the contact details for that is info@xpsurveys.co.uk. Cool. Final one is a social media marketing assistant. That is for Aura and XP Surveys. So that role will be split between the two businesses. Lots of great content available for us to be filming, amazing homes to from an architectural and an interiors perspective to showcase. And then from an XP Surveys, it's about hitting B2B clients, piquing their interest, liaising and community engagement with architects and B2B sales. And if you're interested in that, then drop us a DM or email info@xpsurveys.co.uk. Cool. Any four of those? If again, it's not you, but somebody that you follow these podcasts, you tune in regularly. If you could rack your brains for the best person that you can think of within your network for each of one of these, and drop them a message, I'm sure they would appreciate it, and we would appreciate it too.
Yeah, I just want to add to the slide before we move on, Ben. Mm-hmm. At least twice a year in our business, we do something called an ENPS, which is Employee Net Promoter Score. We've actually shared it. Business owners should be implementing that into their management and sort of HR, I suppose. But we typically score sort of well above 8, in sort of mid-range 8 out of 10. And it's basically whether our employees would recommend working for our company to other people. So if you want to find a good home for a friend, or even looking yourself, we're all ears.
Cool. Good stuff. If you get value from these podcasts, which we know you do, then please rate us, review us, share it with your friends, share it with WhatsApp group. I was actually told last week, I met an investor who found us and started engaging through some posts in one of the sort of property WhatsApp groups around St. Albans. And he says, you don't post enough in WhatsApp groups. And he's probably right. I'm sort of hold back. And he was like, you are doing yourselves an injustice. The amount of value that you give away on these podcasts is ridiculous. You will be doing everyone a favor by posting it into those groups. But yeah, for some reason, I don't feel comfortable doing that all the time. So if you do that for us, that makes it far easier. And it shows that, the people tuning in do rate what we talk about, rate the value that you get every week, and share it really wide. So yeah, it really helps us. It helps the show, helps the podcast, and we'd be very appreciative of that. For those that do tune in on audio format, there is this was recorded on video, so there's lots of stuff that we show on screen that you can't see on the audio format. So make sure you do also subscribe over on YouTube. But we're always at Spotify and Apple on Mondays at 5 a.m. So the video recording is put into audio format and it's posted across the various podcasts. So yep, tell your friends about the Property Experts podcast with Jack and I. We would love you forever.
Cool. Burnham. So he came in on Monday. He's already making a bit of noise. Have you seen these, Ben?
I have, but only quickly. Yeah.
Yeah, cool. So starting off with number one, he's looking to remove. Basically, there's currently 5% VAT on household domestic electricity bills, and he's announcing that he's just going to pull that down to 0, which is hopefully going to reduce household bills by about £45 per household per year. I mean, that sounds low to me as a saving if it's 5%.
Mm-hmm.
I think my electricity bill, I mean, the average household, let's quickly do some maths on that. I mean,
Yeah, I mean, my electricity is only £73 a month, and that's but that's going to be a bigger house than a 1-2 bedroom flat. But also, we've got PV panels, and it's only 10 years old as a house. So, yeah, I'd imagine most people's bills are,
greater
on that. Yeah.
But good move. I mean, obviously, we have had huge utility cost inflation. So where there's an element of lack of control over the cost of the electricity, he's obviously foregoing and just dropping essentially a cost to the tax, which I think is great. I think that it's interestingly, it's like, how do you gauge this? Because if someone has a really big house that costs a lot to run, they're also getting that 5% discount, which is not really a Labour way to tackle things. I wouldn't be surprised if there's a cap or whatever it may be, but it's an interesting one. They say it's going to be funded by cancelling the planned digital ID program,
which is good. Yeah.
Yeah.
Nobody wants that.
Very good. Very good. Well, weirdos do. A national rough sleeping program, which is to basically expand for support for ending the rough sleeping, including funding for housing first star accommodation and supporting services. And I think that's a great one. I actually think that the people on the streets are somewhat neglected sometimes. There's a the housing hierarchy for support in this country isn't very well operated. So it would be great to see some of that change. The better ones are actually to the bottom. For some reason, it's so small for me, I can't really see it. Cabinet and government restructuring. So I don't know if you've seen the new posts that he put in. Obviously, our lovely Rachel Reeves is taking a nice position there. But these are the main ones that I actually wanted to go through, which is 20% reduction in business rates for pubs, clubs, and live music venues.
Yeah, I mean, what about the rest of the the high streets? Pharmacies and opticians and all that good stuff that rejuvenates high streets. They're all struggling as well. Sounds like they're more in Labour government are more interested in maintaining the Friday and Saturday night go out and get pissed and take advantage of all that social stuff.
I must say, I'd rather go to the pub than go to the opticians, Ben.
I mean, yeah, granted, yeah. But it's still
has the opposite impact. Come out with worse eyesight.
It's just Saturday night on a night out, you probably need to go to Specsavers. I mean, I just feel like it helps, and it helps those particular businesses. But we've just been absolutely battered over the last couple of years as a business. Turnover taxes and rate hikes and backtracking on promises that these things wouldn't get increased. I mean, it just blows my mind. It's obviously going to help those people, help those businesses in particular. That does have a trickle down effect into the economy, and but not a huge amount as far as I'm concerned.
Yeah. So interestingly, I read a paper. Well, not a paper, a digital paper. I read a paper about matters of the way that they might fund this is to increase business rates on industrial. which would be quite a big shift, because with industrial's just been really strong, and actually stronger than office in argument.
Yeah.
And it kind of probably does need to be taken down a peg slightly,
Mhm.
and it will diversify the investment interest across the market, which means that you might have some more stabilized landlords, 4 pubs, 4 clubs, 4 live music venues, blah blah blah. So they're kind of taking from one really successful asset class and helping the hospitality sector as a result.
I think if, you know, there'll also be a lot of people that do operate from those types of industrial assets that aren't doing well. What you're talking about is the Amazons, the big sheds, and that type of industrial is really going, massive, and has been over the last 4 or 5 years. Data centers, all that sort of stuff, and yeah, they can probably afford to shell out a bit more, but there'll be lots of family-run businesses that have been going for 10, 20 years. They operate at, kitchen, small independent kitchen and bathroom suppliers, furniture sales, so all that sort of stuff that need these industrial sheds. Are those the people as well that are going to get hit even more? Over the last couple of years, the business rates on everything has doubled. If that's going up even more for those types of businesses, then they're going to have issues. And yes, they've got to get the money from somewhere, right? But is it the right place to put reductions or not? I don't know.
Yeah, I mean, the business rate stuff is a bit broken. I mean, the fact that the small business rates threshold hasn't gone up, or changed significantly.
Yeah.
But yeah, it's an interesting one. That was it. I didn't really have many others to go through per se. Other than just generally talk about, I know we're going to come on to sales, so sort of sales incentives, but the sort of strategy he wants to drive for housing, obviously he's a massive believer of bottom-up support for housing. Their 1.5 million target that they're supposed to have achieved, they're tracking at less than 50% on that. So it'll be interesting to see if there's any drastic changes that do come into play. I've also read some policies around like some sort of portable temporary accommodation, which Ben and I actually saw some up in Leeds when we went to UK Reef.
Yeah, I think I commented on that. There might even be a separate video around porter cabins offering sleeping accommodation and temporary accommodation for various people. And it's a really, really interesting model. They've obviously got the skill set, the factories and the history to roll out this type of thing. And when I say porter cabin, you're thinking of site welfare units, and obviously that's what they're known for. But they'll be rebranding this as something else. Ultimately, it's off-site manufacture. These units were lovely. They were so, compared to what I've seen some social housing look like, these things were brand spanking new. They had they're talking about a brand collaboration with IKEA for the internal finishes and fit out, brick cladding on the outside, well insulated, perfectly, usable size for people, great for families. You can connect them up and create a 3-bed unit, a 4-bed unit, that sort of stuff, really adaptable. So I really like it. And I'm glad that's being talked about a little bit more. I still do think that there hasn't been any real talk in terms of the property industry with the Labour government so far, and ultimately it's at a standstill. It's on its knees. Something needs to happen. And what I do like, there's not much I like about him, but fundamentally I do, from what I've read, and the impact that he's had up in Manchester in terms of that development and housing delivery, etc., has been very positive. So I'm hoping that he understands how much of an impact the property and construction industry has on the economy, because to date it's doing nothing but plummeting, and it needs to be turned around. So yeah, we will see. Early days, I guess, but we shall see where that goes. And talking about the economy and sales updates, yesterday we completed on one of the flats at Muswell Hill, which was amazing. And as of today, it's taken a long time to get here. We have completed on the final unit of our Marlow scheme. So that's the 8-unit scheme that we developed in Marlow. We finished on this site a long time ago, but this one fell out of bed, got back into bed, and the new buyers just dragged their feet with various issues. But we got there. We got it over the line today. That is us fully out of the project, profit delivered, and everyone's happy. So I sort of said in the group this morning, these sorts of things should be a real celebration, but it's turned into a bit of a relief more so than anything. So it's dragged on for so long that's the sort of mentality I have at the moment. But great to have it done and dusted. 8 new homeowners there, just fantastic flats right off the high street in Marlow. Really great finish, high specification, really good use of space, and really happy to have that one over and done with. I think from a sales update perspective, we're still seeing sort of steady inquiries. We had a great open day on Saturday last week. In fact, I should have run a slide for that, but we had an open day at the Old Maltings. We had an open day at St Andrew's Court. Between Friday and Saturday, we had up to 15 people at both sites, which is awesome. I think there's been a lot more interest in St Andrew's Court because the project is more progressed. The scaffold down, ultimately all of the construction works are now internal, so from the outside it's not such a mess. Whereas the Old Maltings, we've got utilities trenches still going across, we've got walls going up in the landscape, and we still have scaffolding up. So I think most of the sales agents that I speak to at the moment are saying off-plan sales are really struggling, and I can definitely see that. So I think as part of a sales strategy, you want to be selling as fast as you possibly can, but sometimes it is better to wait an extra 2-3 weeks to get something finished on site, so that when those people come to visit, there aren't any barriers to that sale that they think, I'm looking at a construction site, I don't have the vision to sort of see where this is going. It looks okay, but it's not wowing me. Whereas if you wait a couple of weeks and you get that work finished, and you do wow them, there's often a good chance of getting, better offers over the door, more offers over the door. So difficult market. Let us know if you're struggling down below. And if there's anything we can help with over the last month or so, we've given away lots of tips and tricks on this podcast in terms of the sales process. So make sure you go back and watch a couple of the previous episodes, and hopefully you can sort of swipe and deploy some of those things within your business as well. Sales tips are one thing, but our XP Boardroom is something that will help add value at every step of the development process, from finding the opportunity, structuring the finance, taking things through planning and design, finding the right builders, selling quickly, all of that good stuff. That is what you need to be a developer. And in this market, you need to be adding value at all of those stages. You don't have the market with you. If anything, the market is against you. So you need to be thinking about all the ways in which you can add value at every single step of that development life cycle. And if you want to scale your development business and be guided by Jack and I, award-winning property developers, doing 8 figures in revenue every year, comment Boardroom down below. We'll send you a development brochure, development boardroom brochure for you to look at. We'd love to have you on board. The new cohort is now live, and we've got lots of exciting add-ons that we've added to this XP Boardroom. One of which is to visit all of our sites on a monthly basis with us when we do our site walk around, and also a weekly live Q&A. So all of those 2 extra really big bonuses is something we've added to the XP Boardroom, which we've been running since COVID times. We've been running this for 5 years now plus. So if you're interested in joining that, comment Boardroom down below or DM one of us, and we will send you a pack. Cool. I'm not sure I talked about AI last week. Maybe I did. But obviously we've been engulfing ourselves in Claude, in AI over the last couple of months. We have monthly AI masterminds within our businesses to bring everyone up to speed, to upskill them, to hopefully get them to understand how big a thing this is for your business and for you as even your personal lives. I got it to review some of my Amex statements the other day and generate something that would have taken me like half an hour. It did it in 5 minutes, and just time saving skills like that is what it's all about. And I wanted to run through some of the stuff in Claude that we've been looking at recently. And what spurred this was a conversation with Heather this morning, when we were talking about some of the things she was doing, some of the tasks she's doing at the moment, right? How can we automate them? How can we systemize them? And I talked a couple of months ago about not having people siloed within their parts of the business and actually sharing information across to other teams, other departments, other companies, and not having people create amazing things on their computer and no one else having access to it. The types of things I'm talking about here are skills. And as you can see on the screen, just very, very loosely, a Claude skill is a reusable capability that gives Claude the instructions, context, and resources it needs to complete specific tasks consistently and effectively. So ultimately, just giving you a use case on this, I've created a skill that gives me a daily brief for my emails. So it's got a standard operating procedure that it pulls into a markdown file that has all of the key things and key steps that it runs through every morning to check my emails, output it in the same chapters, in the same structure, runs through the whole process consistently and effectively every time, which is what the Claude skill is about. So Heather and I were talking about some of the things that she's up to. We're talking about actually taking these podcasts, transcribing them, turning those transcriptions into our LinkedIn newsletter, which if you're not signed up to, make sure you are on LinkedIn, and also turning them into weekly blogs as well. So we're repurposing this podcast across numerous platforms in numerous places so that more people can find it and then tune in. That is a very mundane, administrative, heavy task that could be created and locked into a skill. So in Claude, you can download a skill, which is called Skill Builder, which is Anthropic's generated skill builder, which will basically say, if you typed in, I want you to generate me a skill that downloads the transcript of the XP of the Property Experts podcast every Saturday morning at 9 a.m., transcribes all of the text, creates a draft of a LinkedIn newsletter for Ben to review, creates a HTML web blog that can be uploaded to their website. All of those things can be captured in one skill. You can then set up an automation to run that skill at a certain time every week. And all of that administration that Heather would have had to do is done automatically. All she then has to do is check the output, deliver it to the platforms, post it on LinkedIn, check the draft, press send, and all that good stuff. And that is the power of a skill. There are certain skills that you can create that are not only good for you, but can also be replicated and be used by the other team members. That email brief per se, I could set that up as a skill and send that to Graham, for example, who could then use that skill within his own Claude and set up his own email brief that follows the same process that I do to get my briefs as well. Does that make sense, Jack? Is there anything that I've missed there?
I mean, everyone can always wind it back, but made sense.
Cool, good.
It's actually quite a clear image. Who created that, Claude?
Probably, or some screenshot from somewhere. Just talking you through them. What's on? I've sort of given you my overview. Claude's overview is probably better. So how Claude skills work: you create it, you define the task, instructions, examples, and resources. You activate it, so you use the skill when you need Claude to perform the task. Claude executes, follows the skills guidance to deliver high quality results, and then you receive consistent, reliable outputs you can trust in the result that it is. So inside a Claude skill, you have instructions, so a step-by-step sort of standard operating procedure. You have examples, so sample inputs and outputs, so that it's got clarity on what you're looking for. Any resources that it needs, so references to Google links or markdown files, documents, supporting files that you need. It has the best practices of how you want that output to look, so rules, tips, standards for consistency, and then reusable templates for common deliverables. So really, really powerful. If you're not au fait with Claude skills at the moment, make sure you are. I would say first thing to do is write down, the top 10 things that you do consistently within your business that are administration heavy, repetitive tasks that you could offload, create a skill for to do that repetitive task on repeat consistently. And then you can also set up in Claude a scheduled task for it to routinely run that skill without you even looking at it. So yeah, it's a very, very exciting time to be alive with all this stuff. There's almost endless things that you can do. And yeah, you just need to get out there, start testing it, start figuring out how best to implement these things within your business that will have the biggest impact in the smallest amount of time, and focus on those like top 5, top 10 things for now. Get those nailed down, and I guarantee you'll free up so much of your time to focus then on higher income generating tasks, or really, really important tasks that move the needle for your business. Cool. We sort of touched on this with the Andy Berman stuff, but what does the sales market need? I was thinking about this. I was reading a couple of blogs and insights on LinkedIn and whatever. And there is talk about some form of help to buy scheme coming back, which we've said this for the last 5 years. Like, it needs something to instigate the sales market, create some sort of transactions, because at the moment transactions are still there's not enough movement in the property industry. And a help to buy scheme will help that. One of the biggest sticking points, certainly for the higher end of the market, like even in the affluent market towns that we're working in, where you've got 1 bed and 2 bedroom, well, let's call it 1 bedroom flats in St Andrews Court and the Old Maltings. What has been done from a stamp duty perspective is great. Even at the sort of 225 grand level, I think there's still like £0 or like £1,000 worth of stamp duty on those assets, which should instigate a bit of movement at that level. The reason that it isn't, because there's all these other things that are impacting it, mortgage rates, but help to buy would help out that side of the market as well. Where the real big issue is somebody like me who would be a mover. We've lived in this house for 5 years. If we wanted to move locally, it would cost us an insane amount, tens of thousands of pounds in stamp duty to move. And it's stopping those, middle movers doing that and freeing up those properties for people to move from the first time buyer 1 and 2 bedroom flat to the first house that they buy. And that's that trickle down effect from the top, where you've got people not wanting to move at the top end, at the higher end of the market, more expensive end of the market. And that stops all of those transactions kind of filtering down, and that movement happening within the property industry. So I think stamp duty, obviously, is a big talking point, is something that needs to change. But some sort of help to buy instigation would definitely create a little bit more buzz and movement within the industry. Anything else that you think will really help?
I mean, did you touch on the seller paying stamp
No,
duty?
I didn't really touch on like solutions. I think there needs to be some sort of change.
Yeah, I mean, the biggest problem we have with buyers in the UK is a couple or an individual that's on fairly decent money can afford to rent someone's house that they wouldn't be able to pass a mortgage application for the leverage that they need to buy it, but they're paying them and then they're paying their mortgage with it. So if you think about that for a second, the affordability criteria is just too rigorous on first-time buyers and second-time buyers. So I think that's one point, like improve the affordability of the people in the market. They're willing to buy, but they just can't get the leverage of the product they need because of the affordability criteria. So I think that needs to be changed. And then I do think it unlocks a little bit more free movement. What Ben's referring to is that transactional costs for stamp duty and land tax. I think if you're getting onto the property ladder, that's less important. There is actually first-time buyers allowance. But if you're in London, you don't massively benefit from that, because I think it's only up to the first £300,000, which is actually the average purchase price in the UK, but not the average purchase price in London. So that's another thing to be thought about. Should they up the allowance for first-time buyers? And then there's also talks of this sellers engaged stamp duty. What they're basically saying is all of the wealth is sat with the baby boomers and the people that are sat on assets and capital. And if they then say, right, now the buyer doesn't pay stamp duty, but the seller does, then it's hopefully going to promote movement from the bottom of the chain. I mean, I actually feel that makes so much more sense to me, because when you're looking to buy someone, unless it's commercial, yes, it is like a step in the right direction, but I feel it would then always be a buyer's market, which is really good for speedy sale. It would always be a seller's market. So there'll be less stock on the market. And when you do put it on the market, it would sell quicker. I don't know if that would stagnate a lot of people selling. Obviously, there's natural causes of sales, you know, death, marriage, divorce, and something else. Death, marriage, divorce, and birth, I think, which are natural movers in the market. But when the sentiment is low, that activity is constrained. I do think there should be a first-time buyers promotion. It kind of enables first-time buyers to overcome that original problem that I talked about, affordability. But it's just tough at the moment. And that's not just us being like, oh, we got shitloads of flats, it's really difficult for us to sell them. I feel like we're actually doing okay, but it's more actually, I'm talking about someone that can't get onto the property ladder. It's tough for them too. Then you've got people that are in the middle of the property ladder who don't want to move because it's so expensive the transactional costs are so expensive. So they end up just doing a side extension and putting in a little bar at the end of their garden that's got a one bed in it and a toilet. And then you've got the people that have to downsize because they don't want to live in a big house, which is still moving, which is actually where we try and target a lot of our buyers. So that little top tip there for who to be focusing as a buyer. But I kind of feel like that's most of the market that's stagnated. And also another top fact is the highest cost to the taxpayers' money that goes into the government is benefit and welfare. The largest portion of that is state pension. So we've got loads of people that want to get on with their lives, go start a new business, go get a new job, go start a family, doing all these exciting things. And everyone's struggling below the baby boomers. And then you got the fucking baby boomers taking more money in their state pension that are like, oh, well, I might downsize. Don't really need to. My state pension pays my electricity. But, you know, it's just really top heavy. I mean, that's crazy. Like, if you actually compare the support for elderly against the support for education and healthcare, the support for elderly is higher. Mm-hmm. Which is nuts. It's kind of like, you know, that was the era to be born. Mm-hmm. If you wanted it more cushy, definitely.
Yeah. I mean, there's certainly now it is for sure. When you look back at kind of the lives that they led to get to this point, I feel like we've got it a lot better and easier. But I agree. Yeah, it's extremely top heavy. There's a lot of money and sort of assets there that are stagnating and not really trickling down through the economy. One of the other things that I was speaking to somebody today around AMLs, you know, that sort of anti-money laundering process and the additional red tape that is part of that home buying process now is insane. Like, this guy was a cash buyer, you know, he's just been accumulating wealth, and it took him a long time. He had to do extra sets of accounts and spend tens of thousands of pounds with accountants kind of pulling all that stuff together just to buy a house in cash. And it was just, you know, that's the sort of thing that we're dealing with now, that everyone that's in that home buying process, instead of it taking, you know, 8 weeks to get something over the line, it's taking 16. And so, you know, you sort of wonder why. And it's because of all this additional stuff, the red tape that we have to go through at every stage of the process. I do like the murmurs of the sort of property, what do they call it? Like the property book, you know, the sort of digitizing. Digitizing. I mean, we're
so ancient with properties. Yeah,
for sure. You know, the process could be way more automated. All of the information on the property could be logged in some sort of, you know, blockchain technology, where it's it's quick and easy to access. Even getting local searches nowadays might take 3 weeks. That is just too long in this day and age. Like, all that information is there. Like, why does it take 3 weeks to get that information back? It's ludicrous. So I think, yeah, I just wanted to talk about a few of the things that we think would help spur the market on. I'd love to know your thoughts down below. Drop us a comment on whatever platform you are tuning in on, because we'd like to know what our listeners think.
I actually do have a question.
Cool.
Tristan JBB from Instagram. Hello, Tristan. We'd love to pick your brains. I'm 24, doing lived-in resi flips. How can I scale this? Am I best doing 2 flips at once to grow my pot, or start to keep them as buy-to-lets, which would eat a chunk of my capital? Really good question. I would say the easiest answer to that is, what are your goals? So, Tristan, if you would like to be active and working on this business for a decade, I would say that you're probably better off keeping your cash liquid and being able to reinvest that into projects. If, on the other hand, you want to work for 4 years, then go travel the world for a bit, then it may be an idea to build income. We like both. We like the sort of the blend of both of these options. The income's great because you don't need to necessarily have all of those cash strap items where you got a big project and then it's overspend and it really impacts you, and you can kind of build your personal wealth and income via rent. But I would also say really monitor the returns on cash, because you may be doing flips and getting, let's say, for example, on the projects that you've delivered 10% IRR, so annualized return. If you can generate that in a buy-to-let portfolio, it's a lot less work for a similar return if you can generate that. So for me, it all boils down to the numbers. And actually, when we look at deals, we monitor that detail at the beginning before we've even bid on it, and almost have an inherent opinion of what we're going to do with it at the end and make sure that's structured correctly. I would also say the easiest way to scale all this is get really good at it and get people to lend you money to do it with them. And then you can kind of do what you want with your own capital, whether that's buy-to-lets or flipping as well. Because that is, if you're looking for scale, we've found that even if you build your own cash pot, you might be still doing a deal a year. You can then expand on that and utilize what you've learned, grown and delivered to work with partners and resource sort of aggregate. So that's my view.
Nice. Very good. Cool. Well, thank you as always for tuning in. We'll call it a day there. Enjoy the sun, enjoy the afternoon. We are here every 4:30 on a Friday. We are now at almost 200 episodes. There's lots of value to be gained from going back and rewatching. If you're a business owner, if you're a property developer looking to scale your business, there's so much for you within the back catalogue of these podcasts. So go and tune into some of them. Until next week, have a good one. See you then.
See you. Bye.
Bye.